Good morning to everybody, and we're live. Welcome to the Friday edition of Behind the Markets, and it is Futuristic Friday, or at least budget, and that's where there's a lot of information happening. There is a lot that is at stake happening today, and it is the Futuristic Friday budget. For now, good morning to my co-host Stephanie, and how are you doing? Right. So let's get into the main data points of today. The first thing that we will see is one, the kwacha has did lose a bit of strength yesterday, down 0.6%, up 0.3%. As of the week, but the dollar is up 3.55% on the last month. Still in a buying pattern, but the stock market also continued to rally yesterday as Zanaco went into a further increase of its share price, and Puma Energy also did recover some of its stock, up 0.37%. 7 days is up 0.49%. Index up 6.62%, up 24.48% on the year to date. We did see that the bond index was up 0.06% yesterday, while the US dollar bond index was down 0.59%, and we saw interest rates climb up a little bit by 0.01% after days of interest rates coming down. We did see that exchange rate went back up to about 20.94, as you said, up 0.69, but up 15.69% year to date, while the rand was up 0.81% and up 2.65% year to date. We did see that the government bond index is up 21.2% year to date and up on a steady 0.6%. But year to date in dollars, it's up 4.75%, while interest rates are up 0.65% year to date and up 0.018% yesterday. Copper moved up as well, 2.15%, while oil dropped down a little bit to 1.99%, and gold was up 0.48%. We have had some questions about the alleviation of fuel prices. The only thing that we are doing, you see, what most people need to understand is that part of the issues when it comes to the fuel market, one has to be the processing cost, and two, just getting the stuff here. It's difficult. The only options that start to lie are the long-term ones, which we're actually trying to work on as a country. And I think if you've seen, there's the Sonangol plant, which we have invested in to try and make sure that refinery should be online by 2026. With the continuing of the Lobito corridor, that will actually be able to help support lower supply chain costs of fuel, especially the fact that it will be refined right here. Well, secondly, the other option is obviously trying to work on the diesel line, but there's also the Namibia pipeline, which is also set to go online in 2029. Structural changes to the oil price are quite long and arduous. And also, the unfortunate thing is that in the total year, what you have to remember is that totally you do find that oil prices are relatively high. We did have a question that was, I think, sent to us regarding can we start working government to government to bring the prices down? Possibly, but unfortunately, every government is trying to defend itself right now and keep fuel reserves for itself. So you're asking another government to make sure that it prioritizes our citizens over their own citizens. And that's where the difficulty starts to come. They are going to try and make sure that they hold stock. And two, they're not going to disadvantage themselves for an opportunity to start making dollars on oil. So the best thing we can try to do as a country, which is what we did with diesel, is when we actually put the pipeline in, you'll actually see that diesel used to be more expensive than petrol. Now diesel is cheaper than petrol because we changed the supply chain. That was the important thing. There was an actual change to the supply chain that actually dramatically changed the diesel price. It is changes in the supply chain that lead to changes in price being more sustainable. But the problem is we don't produce oil, and these are the difficulties of importing a critical resource. In other news, we also did see that our expected pump price is going to be about 33.07, 3 quarter 65 up expected. That's our expected pump price change that's expected on Saturday night. Up 12.41%. That is what we're expecting at the pump price, if not more. Bitcoin is up 2.7% in Kwacha, while Ethereum is up 3.3% in Kwacha, and gold is up 0.1% in Kwacha. Across assets, we are looking at the fact that bonds up 21.1%, stocks up 26.5%, USD up 15.7%, gold up 19.4%, while Bitcoin is up 88% and 59%. But remember, that's just got to do with first quarter. If you look at yesterday, you did see that the bonds up 6.9% for the quarter, and they look like they're going to end somewhere around 7%. While stocks are going to be up 12.6% on the quarter. Dollars are up 19%. Gold is up 16.3%, Bitcoin 5%, and Ethereum 2.6%. Now, in as much as these USD and gold and Ethereum look strong, if you look at them versus the last quarter, you'll start to see this is a seesaw. While you're looking at bonds and stocks, they're actually piling onto each other. And that's why they're actually quite effective in terms of where they are through the data points. Now, yesterday we did see some information coming out. It was Zamstats that actually did release inflation data for yesterday. So we do have our monthly inflation report that has come out. This handsome fellow is going to take you through it. September did see inflation rise from 10.85% to 11.97%, while remaining in double digits for the third consecutive month. Food inflation rose from 12.6% to 13.135%. Non-food inflation rose from 8.49% to 10.12%, mainly due to transport inflation, which rose to 13.3% to 22.9%. This is the highest level of transport inflation we've seen in 29 months. And core inflation, when you strip out food and transport, rose from 7.53% to 7.66%. So we're seeing a little bit of mundaneness in the main parts of the supply chain. Now, the most pronounced part of inflation was transport prices, which contributed 57%. While food prices were 38%, so 95% of the annual change in inflation moving upwards was due to transport prices and food prices. And this period saw record mini meal prices, which are up by 62%, and record petrol prices, which are up by 37%, both of them year on year. And inflation is likely to close at about 12.6% this year, with food inflation likely to close at 14%. And by the way, these things are actually getting higher and higher. The expectations are starting to rise. As you can see, a strong upward turn in food inflation, strong upward turn in non-food inflation, while the black line, which is core inflation, when you strip out food and transport, you can see that that's now much more under control. As you can see that food inflation came in higher than the expectations curve, the monthly benchmark, which is the red one. This is the consecutive month inflation in general, the fourth consecutive month we've seen inflation coming in higher than expected. Same thing with food inflation, came in higher than expected. This is meant to be the most deflationary month of the time, but unfortunately, we're still getting relatively strong inflation coming through the system. Simultaneously, we did see that prices of mini meal have continued to rise rather strong. Obviously, this is also supply chain factors, and also you need to bear in mind that fertilizer costs are going to start rising very soon. We're getting relative hikes in fertilizer prices globally around the world, while we're also seeing breakfast meal prices in general. As we said, this is the prices over the last 12 months, while simultaneously we should be looking at also if we're looking at inflation rates of breakfast meal up 67.37% as of September. This is really spikes in breakfast meal prices that have gone up. And then also just grain inflation in general, in terms of grain prices, they're up 47.8% from where they were year on year. Now, non-food inflation also came in really hot, 3 times higher than the expectation, 0.9%. In fact, this month, non-food inflation was much higher than food inflation, and that was strictly due to transport inflation. Transport prices jumped up by 3.2% last month. The only other prices I think that came up near to it was health prices and also restaurants and hotels. But transport prices, the long shot, the key driver. And as you can see, transport inflation up 22.9% from 13.3%, while everything else is still maintaining a slow point, except the food inflation is only up slightly. Recreation inflation also went up a little bit as well during the month. And as you can see, in terms of monthly inflation, you can see the key driver was food and was transport inflation that was trying to push it up. But monthly inflation was mainly pulled down thanks to food inflation slowing down on the month. But if you look at year on year, transport inflation is the key contributor. This is the percentage contributor for annual inflation. Now, in terms of global inflation, you can see that we also have to look at what's happening on the global economy thanks to the FAO and World Bank Index. You can see that in the last month, we saw fertilizer prices jump up 8.5%, following a 5.3% spike in fertilizer prices. That's going to affect us because remember, we import the majority of our fertilizer. So therefore, that's going to also affect the FX rate. Cotton prices also went up by about 3%. That may affect some of our exports, but also will affect textile imports as well. While sugar prices rebounded back by 1%, and tea and coffee prices up by 1.4%. So we're starting to get a mix of positive inflation in food prices globally. Now, if you're looking at year over year still, sugar prices are the only things that are really up 34.1%, with timber prices up 3.1%. So two exports are actually showing positively in terms of inflation, while fertilizer prices are still down 24.9% from the highs that they were last year. Now, added to this, if you're looking at month-on-month inflation globally, one of the key concerns here is this black line. This black line that you're seeing here represents global energy inflation. And as you can see, global energy inflation month on month is up 7.8%, and it's pulling up global commodities inflation. So if you're trying to control energy prices, the problem is it's coming from outside. And this is the data point that actually shows you that the fuel prices coming from outside, it's very difficult to navigate around this problem, especially when we don't have the local fuel itself. It's very difficult to control prices. That's why every country that has to import is literally under the gun when it comes to this. And I think what's also making it worse is metals inflation, metal price index, is still in the negative, minus 1.9%. So when you have energy prices up and metals prices low, that also reflects that you're going to have a weak kwacha because we export metal and import energy. That's where the problem starts to come for us as a country. But year on year, energy prices are still 37% below where they were last year, and metals prices have also jumped out of the positive, and everything is still in the negative realm for now. So our analysis is showing that for the second, obviously this is the fourth consecutive month, and we are starting to see that inflation is still coming in hotter than expected, but at the end of year, we are expecting about 12.6% inflation. But one of the other factors I think that is of concern to me is core inflation is actually going to probably end the year around 8.6%, meaning supply chains are a little bit weak in this country. And part of the key global risk factors, obviously, energy and fertilizer prices. To me, that's a big risk. That's also going to now combine both imported inflation and forex-fueled inflation, where the things we import in kwacha are also going to become more expensive. So similar to BOS inflation expectations, we see inflation ending the year 12.6%. Expectations were 12.1%, so we've had to raise the expectations. Food inflation is expected to end the year at 14%. Our previous expectation was 13.8%, and non-food inflation is likely to end the year at 10.6%. Our previous expectation is 10%. So all of our expectations have had to rise in terms of inflation outlooks. Now, if you're taking a look also with Q2 GDP data, one of the positive signs that did come is we did see surprise GDP growth in electricity and construction, while ICT, education, and transport and finance all pushed for high growth. So we're no longer looking at stagflation. We're probably looking at what we call an inflationary expansion, which means you can now take some risk, but you just have to be cautious. So the economy is growing. Unfortunately, so is inflation. It's running hot as well. But however, continuing rising oil prices, fertilizer prices, and strong consumer imports are going to keep putting pressure on dollar demand. That's another concern, I think, for all of us right now in this country. And therefore, we're likely to see inflationary pressures still be on both businesses and households. And high inflation and unresolved debt is likely to keep interest rates. So if you're a bond investor, expect the yield to stay higher for longer. So if you're a fixed income investor, it is advisable that you do have your portfolio somewhere to the 3 to 5 year. But I would say you have some room now to take a little bit of risk. Now, you do it cautiously and under some advice, but high yield debt funds, for example, unit trusts that invests in corporate bonds. Those might be an option, and also high interest deposits. Simultaneously, you are seeing that equities portfolio in essential and commodities driven stocks could also be potentially good, with timber prices and global sugar prices still rising. Commodities exports are likely to see stronger margins. So if you're a sugar exporter like Zambia Sugar, you're likely to see stronger margins, especially in the second half of the year. Timber exporters or timber growers, you might see that Zafico might start to see some positivity due to stronger timber prices. A negative outlook on the forex rate, however, is also going to be positive for companies like CEC, African Explosive, those that export and don't have much domestic import exposure. So investors are advised, obviously, to be careful to be careful of stocks with high forex exposure, because that'll compress their margins even further. And also those who are exposed to high transportation and logistics costs, they will also feel a lot of margin compression. Though growth might be increasingly optimistic, you must exercise caution. So that's the inflation outlook, where we saw inflation move to the highest that it's been for 18 months. This is the highest that we've seen annual inflation in 18 months, going to the end of the month. Other news that came in yesterday, we did see trade data coming in as well. And trade data also showed some positivity in general trade for everyone. So keep an eye out on some of the trade data that we've seen. August 2023 saw the fifth consecutive month of rising net trade, with the third consecutive month of positive net trade. However, we did see a slight drop of 5.3% in net exports, down to $118 million. Month-on-month imports rose by 6% to $860 million, and exports rose by 4.5%. However, that pushed a decline of the $5.3 million and 5.3%, and still down 14.3% from where we were in August 2022. Key drivers of exports was mainly due to export growth was mainly due to record export in agriculture, thanks to oil cake, which was up 75%, sugarcane, which was up 32%, and tobacco, which was up 35%. Simultaneously, copper stayed above 70,000 metric tons for the second consecutive month. However, the slight drop in net trade was due to the fact that consumer goods imports did rise 312 million. So we were importing consumer goods and finished products. So this was the first sign that we've also seen year-on-year positive export growth for the month. As you can see here, we've had some strong momentum in net trade, picking up all the way from March, which was the deepest contraction. But we've had strong momentum in net trade, and this is the picture that we've actually seen. As we've seen, raw materials imports did rise slightly, but the main strong one was consumer goods imports and capital goods imports. They both went up 14%, 7.6% and 14% respectively, leading to a 6% reflection in growth in imports. While export growth was up 4.5%, that was mainly driven by a 28% rise in agricultural exports to a record level. We have never had a month of agricultural exports of $122 million. We saw $122 million of agricultural exports, mainly, as I said, due to oil cake, which goes to Botswana. That was up 75%, and 32 and 35% in terms of sugarcane and in terms of sugarcane and other crop. What we have seen is cumulative net trade is still at about $602 million. We're on track to potentially close the year at $1 billion. We were seeing less than $1 billion, but now we are potentially on track to close the year at around $1 billion worth of net trade. That'll still be the lowest since 2019. Simultaneously, as I said, we did see the first positive, as we see here, the 4% rise in August 2023 export versus what it was last year. That is the first positive month of year-on-year growth in export since June 2023. We have seen that however, imports are still up 15% from where they are year-on-year. That's still putting pressure on the exchange rate. Monthly exports, as you can see, agriculture exports still sitting at about 122 million. Non-traditional, non-agriculture exports up to 249 or 250 million, while traditional exports at about 607 million. That's what pushed things up. As you can see, agriculture exports for the first time were 12% of the full export kitty pool. In terms of imports, we did see we saw consumer goods imports bounce back from the drop below 300 million back to above 300 million. So we've pretty much had a strong average of $300 million worth of finished good imports, while simultaneously we've had intermediary good imports also around $300 million. Capital goods imports did recover back from its slump down, $186 million worth of it, while raw materials have continued to stay suppressed back to about 52 million. Now, in terms of biggest composition, we are seeing that the import share is still being held 72% between intermediary goods and finished goods, and that's the year-to-date figure that we're seeing here. Year-to-date, we are seeing that copper output, where we are in terms of traditional exports, as low as they've been, just slightly higher than they were in August 2020, higher than they were pre-pandemic, but still lower than the last two record years. While non-traditional export, and I think this is the one that's really impressive, non-traditional export, non-traditional, non-agricultural export is already above $2 billion. This is mainly due to strong exports that we're also seeing in things like electricity, nickel. They're doing pretty strong during this period, while agricultural export is being driven by the ones which we had mentioned before. Now, if you're looking at percentages, agricultural export is doing much better, and non-traditional export is also doing much better, 28%. So we're seeing our diversification of exports seems to be playing out quite well. As you can see, only 64% of total exports this year have come from the copper sector. That's also due to weak performance in the copper sector. However, if you're looking at imports, we did see that consumer goods imports are also at a very high point due to a combination of weak supply chains domestically and high inflation globally. $2.2 billion worth of consumer goods imports, with $2.5 billion worth of intermediary imports, while capital goods only about $1.4 billion, and raw materials are $570 million. So these two have stayed mute. It really is a battle between intermediary goods and finished products. Those have been the main drivers. In terms of copper outputs, we have seen about 530,000 metric tons of copper, down 11.7% from where it was last year. While we're looking at the monthly, it's down 1.2%, but still above the 70,000 per month. And I think this is good for in total. However, we are seeing very weak copper output in terms of where we are. We are lower than where we were pre-pandemic levels, 530.6 million. But as I said, it's the second consecutive month that we have seen copper output or copper export at 72,700, above 70,000. It is the second consecutive month, leading to the second consecutive month where we've seen copper export earnings above $600 million. So that's actually what's also maintaining that's also what's maintaining it. But the star of the show, the biggest star, has been the fourth consecutive month of rise in agricultural export, with $122 million worth of agricultural export, leading to a record level, and potentially we are on track for agricultural exports to close the year at 1.05 billion. So the second consecutive month of of net trade staying above $100 million, mainly due to copper exports and also strong agricultural exports. Now, year on year, we also saw that the reflecting of positive growth for the first time. However, the trend has been moving in that direction. We've been getting towards positive export growth. Consumer good imports have rebounded back, and this is also due to elevated global prices, do show fragility in the domestic supply chain. Non-traditional, non-agricultural exports, as we pointed out, contributed 34% to export growth, mainly thanks to a 75% spike in nickel exports to $14 million, and also additionally electricity exports stayed strong at $35 million, with it mainly going to Botswana, DRC, and Zimbabwe. What we also saw in the market was that August saw the fourth consecutive month of agricultural exports, as we pointed out. This was due to oil cake, which is made from soya, up 75% to $20.4 million, mainly going to Botswana. Tobacco exports were up 32%, mainly going to Switzerland, 20.34 million kwacha, and raw sugar cane up 35% to $17.5 million, up to mainly going to DRC and Zimbabwe. Simultaneously, we've seen 12% composition of agricultural exports, and also agricultural exports are on track to get to $1.05 billion, and that's putting us on the path for the $2 billion target in 2026 as per the 8th National Development Plan. Now, obviously, due to surprise GDP data, as I pointed out before, growth outlooks are starting to look a bit more optimistic than they were before. Positive growth outlooks alongside elevated inflation does shift economic conditions from stagflation to an inflationary expansion, and positives in export growth also supports this assertion. So therefore, in addition, we have seen agricultural export and electricity export does also show optimism that is likely to push us above that 2.7% projection by the Ministry of Finance earlier. However, there is pressure from consumer goods exports, the imports that will keep, and also depressed copper exports that will put pressure on the forex level. And simultaneously, weak exports, weak copper exports affect government revenue, which will also push yields up. So interest rates and FX rates are expected to stay relatively high during this period. So my recommendations in terms of investment shall be that fixed income investors are advised, obviously, that with weaker copper outputs, with weak copper trade and strong consumer good imports, that will keep inflation and government deficit pressure on bond yields. Therefore, fixed income rates will stay higher for longer. However, positive growth does show that there can be some risk that can also be taken. So in other words, high yield interest rates might also be there, but do it cautiously and do it carefully. We're also advising that trade data also signals positives for various industries such as electricity and agriculture. Electricity represented by stocks like CEC, agriculture represented by Zambief, who are now trying to go major into export, with Zambia Sugar also exporting sugarcane around, which both show strong export markets and potential top-line growth for equities that are exposed to those exports. Strong agricultural exports also a good signal for farm finance and farm banking stocks. I do think that some of these banks also make a lot of their money from agricultural financing. Simultaneously, a weak forex market is also good for exporters who are going to end up generating a lot more revenue and paying down a lot less cost because they're earning in dollars and paying in kwacha. You saw it actually happen in the African explosive stock, which actually recovered quite strongly. However, investors are advised that growth is not full speed, but inflation has high momentum. So exercise caution in the stock markets and also your allocations. So that's where the data comes in today as we prep for the National Budget 2024, which is set to be read today. In a matter of hours, we'll be going through the National Budget 2024. Expectations will be that we will see a lot more growth orientation, although it's actually quite important. So I think even the debt negotiations are depending on what kind of budget is expected to be seen. Will we see a balanced budget with a primary balance? Will we see a growth-centric budget? What will we see from external debt repayments? That's what I think also people are also looking for. What impact will that have on the budget? People tend to see lower spending figures and automatically think the budget is underfunded, when last year all that happened was that the external debt component dropped so drastically while the primary spending actually went up. But where is money being allocated is also really important as to where this budget is going to be. Are we going to see more money going to economic affairs? What are we going to be seeing in the budget? That is going to be quite important. Monday will be the post-budget analysis for us to go into what we're expecting from this budget. With that, we have actually slowed down today, and we've gotten through inflation, which is at an 18-month high. Trade has bounced back mainly because of agricultural export at $122 million, the record level of agricultural export. And with that, we close today. Stephanie, thank you for giving me such a smooth ride. And thank you to all who have been with us. Catch you on the other side. Yesterday was Money FM's 5th birthday. And today is the day that obviously we covered the budget. 5 years ago, Money FM launched by actually covering the budget. That's how big a day it was. And that's how serendipitous this moment is. With that, I wish you all a wonderful and blessed day, a wonderful and blessed weekend. And we did actually address the question regarding what we can do with the supply chain. I think we remember we did have that question. We did actually address the question regarding what we can do with the supply chain. And we did say that it's quite difficult to obtain oil from other countries. Those are agreements that need to be signed, and oil agreements are very difficult. What we are doing are long-term supply chain changes. There is ethanol blending that is supposed to have started. That is a big conversation as to why it hasn't started or kicked off yet, because ethanol blending is supposed to be one of the main contributing factors in bringing down the cost Ethanol blending is supposed to be one of the main contributing factors in bringing down the cost, or potentially at least helping people benefit from the supply chain itself. If the cost of oil is going to be so high, at least let some of it stay within the country in terms of the revenue. That's what we mean by ethanol blending. Now, there are long-term interventions that are being worked on, and I think that's something that we all should pay attention to. But however, in the short to medium term, globally, not even locally, globally, there will be pain because Russia and Saudi Arabia are not going to tolerate low oil prices because they need to capitalize on high oil prices from now until 2028. The biggest part of the growth cycle for Zambia is going to be after 2029. But however, you're going to see a strong growth cycle from 2025 to 2028, but from 2028, all the way up to 2034 about, you should see a really strong super cycle pick up for Zambia. That's what the outlook really looks like over the next 10 years. But the problem is that oil prices will still remain high for a little bit longer, because if you look at OPEC reports, if you look at EIA reports, you will see that globally, not just locally, the issues have to do with the crude oil price and the global supply chain. Those are two critical factors causing a lot of this problem. Right. Wish you all a wonderful day. God bless. See you on Monday.